Our results today are very different from what we thought just 6 months ago, and things are looking up a lot stronger from both a demand perspective. We have had a very, very strong demand in the first part of the year, close to 7% year-on-year growth in container traffic. Probably mostly because of lower base last year. There was some destocking going on following COVID normalization, so the base effects are there. And because those base effects won't be there in the second half year, then the year-on-year growth will come down. But on a sequential basis, it is still pretty strong markets we're expecting. So that is an important factor for us. The second, as you mentioned, is the disruptions in the Red Sea, which have really entrenched themselves and look like they're going to be with us at least for the rest of the year. And that, of course, require more capacity, more ships in order to move global trade around the world. And that has created some shortages here in the second quarter and in the third quarter that we're dealing with at the moment.
Yeah, but what does that mean for margins, though? Do the longer routes, because ultimately meaning if you can't get through the Red Sea, assumedly you'd have to go around Africa ultimately. Does that mean that your margins ultimately can improve on that basis alone? And does it then ease perhaps pricing pressures in the long term or in the medium term at the very least?
So you're right. We're sailing the long route right now to bring containers to their final destination. Because of this, we have to sail south of the Cape of Good Hope. That means in the short term higher cost, and we have had to take on significant cost as a result of this, both in terms of needing more ships and needing also more containers to do the job that is expected of us. But this shortage that there has been as a result also on capacity has meant that it has eased the pricing pressure that we saw in the second part of last year and even at the beginning of this year. And we've seen significant adjustments on pricing, which in the short run is positive for margin. That led to 3 profit upgrades here in the last few months. And in the long run, I mean, it's a bit ambiguous how this is going to play out, because of course the cost that we're taking on will be probably sticky and stay with us for a longer period than the current price situation.
So Vincent, just to clarify that, what sort of inflation do you think is going to be coming through from the shipping industry?
Well, I think as long as, and if this situation continues to stay entrenched and we have to sail for a few years south of the Cape, then we will see obviously significant inflation in our cost base, which we will need to pass on to customers. It costs anywhere from 20 to 30% more to sail south of the Cape of Good Hope to get to Europe or to get to the US East Coast from Asia or from South Asia. So those are significant cost increases. In the short run, actually, the price adjustments have been bigger than that, because compounding the higher cost has also been a shortage of capacity. But in the long run, if this stays with us, then it is actually an increase in cost base and some type of inflation that will stay with us for the longer time.
I appreciate the clarity there, Vincent. Let me just ask you too about the outlook for the United States, because looking at your language today, declining consumer confidence and savings are clouds on the horizon when it comes to the United States and the US consumer. At what point do you think that cloud could become an economic storm, which has been one of the concerns of markets this week?
Yeah, I get that question a lot. I think what we look at is container demand in general is a really good indicator for underlying macroeconomic strength. And we've seen in the last couple of years actually market remaining surprisingly resilient to all the fear of recessions that there has been. It is very hard in the very short run, though, to take away some of the inventory replenishment cycles and the front loading of some of the orders that there might be. We can see today that inventories in the US are higher than they were at the beginning of the year, but they are not at a level that is worrisome or that seems to indicate a significant slowdown right in the offing. We look also at purchase orders from a lot of retailers and consumer brands that need to import into the US for the coming month of demand, and it seems still to be pretty robust. So whereas there is a lot of volatility and unpredictability in those numbers, at least the data and the indicators that we're having seem to point towards still some good level of confidence that the current consumption levels in the US will continue.
Can I ask you about China as well? We've had a lot of mixed signals out of the mainland economy. What sort of signals are you now getting out of the Chinese market?
So China, as an export market, continues to be the engine actually of these strong container volumes. The place of China in global trades has increased in the past couple of years. The share of containers in the world, either originating or being destined to China, has increased. So this is a continuation, I think, of the policies that we have seen being implemented in Beijing, and a trend that we have seen for a long time. However, China as a consumer market, where we have a lot of exposure through our warehouse network and how we serve companies serving this market there, is still showing signs of weakness and not a very robust consumer confidence there.
Vincent, your business sometimes has foresight into just how consumers will spend or continue to spend as well. And there are many question marks right now globally around recessionary risks and how much of that is in play. What are you seeing when it comes to kind of the demand as well from a lot of people? Are you feeling that it is heading in sort of recessionary territory, or at least downturn territory of some sort?
I think what has been a surprise to us is the resilience of container volumes throughout the last couple of years, and the outlook that we have seems to point towards, at least the coming couple of quarters, a continued resilience. We have better insight into the third quarter, some of it being underway and some of it where we have some pretty good purchase order data. That points towards this strong demand continuing. It's a bit more uncertain in the fourth quarter beyond the normal seasonal fluctuation. But at least there is no indication at this time that container demand is pointing towards recessionary territory.